Welcome to the Academy Introduction to Stocks. In this video, we'll look at what stocks are, their characteristics, and how they can be traded. Stocks are also known as shares or equities. A stock is a share in the ownership of a company. When someone puts their own money, also known as equity, into a company by buying that company's stock, they become a shareholder of the company. Because shareholders own part of the company, they have certain rights, and we'll talk more about these later. The word stocks is often used to describe ownership in any company, while shares typically refers to ownership in a particular company. A company can decide to list its shares on an exchange in order to increase the liquidity in the shares and to access new funding from investors more easily. The stocks of publicly listed companies are traded on an exchange, for example, the Nasdaq Stock Exchange or the London Stock Exchange. And some companies have their stocks listed on multiple exchanges. Some companies also have different share classes with different benefits. Like most other assets, the price of a stock is a result of the balance between supply and demand. Supply and demand for a particular stock is impacted by a range of factors. For instance, the market's expectation regarding the future earnings of the company. A popular valuation method for stocks is to discount a company's expected future cash flows using a discounted cash flow model. With a discounted cash flow model, you're aiming to work out what the value of a company is today based on the free cash flow that it's going to generate in the future. The principle behind it is that a company is worth all of the cash that it could potentially make available to investors at a later date. But a discount is applied to the company's cash flow because cash in the future is worth less than cash in the present. Here's a simple example of how the discounted cash flow model works in practice. You have a friend who offers to give you 1,000 euros today or 1,000 euros in a year's time. It's likely that you would take the 1,000 euros today because you could invest it and earn a return of 5%, which would give you 1,050 euros in a year's time. So effectively, you're saying that the 1,050 euros that you would have in 1 year is worth 1,000 euros today. Therefore, the discounted value of 1,050 is 1,000. If you use this calculation to forecast all the cash that you expect a company to generate in the future, then you can make a good estimate as to that company's present value. Another approach to valuing stock is to use valuation multiples in order to compare the stock of different companies operating in the same industry. The best known example is probably the price to earnings ratio. To apply this ratio, you just divide the company's current stock price by the profit that it has made for each share over the past 12 months. Underlying assumptions and expectations relating to stocks are constantly changing. So when market participants are presented with new or additional information about a company, this leads to fluctuations in the supply and demand for stocks, and therefore fluctuations in the price of the stock. The most common trade in cash stocks is a long position, meaning that you buy stocks in the anticipation that the price of the stocks will increase in the future. The opposite of a long position is shorting. This means that you can profit from a falling share price. With shorting, you borrow shares from the individual or institution that owns them and sell them with the expectation that you can buy them back at a lower price in the future. Short selling can be done via single stock contracts for difference. We explain more about this in our Introduction to CFDs video. The costs associated with trading stocks are commission and, in some cases, tax or stamp duty that's paid to the local authorities. On most European and Asian exchanges, The commission is defined as X basis points of the nominal value of the trade, but a fixed minimum usually applies. For North American exchanges, you pay X cents per share, with a minimum amount as well. One of the benefits of trading stocks through certain brokers is that you can use your stock position as collateral for margin trading. We explain more about this in another video. All stock instruments are rated from 1 to 8. This is similar to the rating system imposed on single stock CFDs or index tracker CFDs. The rating reflects how great a proportion of the market value of the position can be used as collateral. A corporate action refers to an event that occurs when a company decides to change the conditions for its shares. As a shareholder, you're entitled to participate in different types of corporate action. Some of the most common ones are splitting stock. By splitting a stock into 2 or more stocks, the company increases the amount of stock available and reduces the value of a single stock. A rights issue. This is when the company seeks to increase the level of its equity funding by issuing new shares. And dividend distribution. This is when a company decides to pay out a part of its generated earnings to shareholders.